area that has some massive issues, especially around fraud risks, and there are transactions and an ISA that deals with the issue of related parties and related party transaction. So it's a significant area, and it's a very sensitive area for auditors. So it's good we pay attention to this very significant area, and it's examinable and always tested most of the times in the AAAF paper. Okay, so by section 1, we'll be looking at related parties and related party transactions based on the unit related party. So we are aware, and by now we know the definition, but just by way of recap, related parties speaks to individuals or organizations with potential undue influence over a company. We know that subsidiaries have control based on our CR, SBR subject. We know subsidiaries have control, but related parties, joint ventures have significant influence, significant or undue influence over a company's transaction. So, for example, we have directors and key management staff could be related parties. Their spouses, their family members, children are related parties. We also have entities controlled by them or by their families, talking about joint ventures and other companies that could be sister companies to those related party companies, and they supply either goods or services to the parent company by way of relationship, and that's where the risk comes in by some of these examples. We also have other companies in the same group in form of sister companies that are not subsidiaries. They are just related parties due to one or two association, and some of these party transactions include material dealings with the company and their related parties, material transactions, goods and services they transact together, and they could be of significant amount as a result of these parties. So management's responsibility is to ensure that they record and disclose all material related transactions. This is management's responsibility, and the reason is because such transactions may be favorable or at arm's length terms, at a non-arm's length terms, and is susceptible to risk of manipulation because of the related party transactions. So just imagine a company floated by the chairman of a company or the chairman, and he gave contract to his wife's company, something like that. So such contracts, if approved by the board and the chairman, his wife has a company or his first son has a company that supplies services or goods to this main company, there are risks of manipulation, and there are risks that from the board or from the chairman coming from maybe a significant shareholder on that management team, the risk of manipulation and the risk of so many overrides could be the reason. And management has a responsibility of disclosing the nature of such transactions, who are those transacting with the company, the identity of the owners of such related party companies are very important, because the risk of manipulation and the risk of undisclosed persons behind such transaction is there. And IAS 24, talking about related party transaction based on the International Accounting Standard, declared that there must be disclosure around the nature of the relationship I just spoke to, the amount of those transactions, and the purpose is to enable users of financial statement to assess possible distortions in the financial statements due to these transactions. So distortions could transpire or could surface on financial statements because of the nature and the transactions around related parties. So disclosure, it's very important, and IAS 24 is clear on that. And the auditor's responsibility with the guide of ISA 550 on related party transaction talks about dealing with related parties as a source of audit risk. Yes, a source of audit risk. And this revision in 2008 came because one of the major scandals in accounting history was the Enron scandal. And it was linked to hidden related party dealings that crashed that corporation. related party dealings was a significant risk that crashed that corporation. So it's very important for the disclosure, and the ISA 550 focused only on procedure, not on risk of misstatement. So in summary, related parties speak to those with influence, undue influence, significant influence on the company, and management is held responsible and must disclose all material transactions in relations to this. Yeah, so just give me a minute, a second. I'll get back to you. Okay. So speaking to related party transactions, pardon me for that little break. It's a significant area because the Enron scandal was as a result of that. And the current dispensation of ISA's IAS implementation and also audit procedures have really are really meticulous about auditing related parties, because fraud and fraud-related risk emanate from such related party transactions. If you look at the fraud in procurement in Nigeria today, most of the government officials give contracts to related parties. You even see fraud cases by government officials where they raise contracts in the name of their children's companies. They raise company, how will I put it now? Not raise companies now. They float companies through their spouses' names and give contracts to those companies. They are related parties, just in the bid to win those contracts and get undue favors and also proceeds from that. So related parties are key areas for auditors, and it's an emerging and a current trend that auditors take very, very seriously. And disclosure, it's very important because that is management responsibility in disclosing every issues of materiality around related parties. Okay, so that's it for the brief on related parties. Do we have any questions on that? Any question on related parties?
Yeah.
Okay, it's fine. So we must understand that auditors, based on these standards, ISA 24, IAS 24 and ISA 550, must assess the risk of misstatement due to related parties, especially given past scandals that we just spoke to, like that of Enron. Okay, so the next section will be looking at the impact. So please feel free to interject and clarify any concerns. You have any observations, any contribution, please go ahead and feel free to interject freely. I'll try to run because it's a long, we have a lot to cover, especially audit evidence, which is the main issue with audit. Without audit, without evidence, you don't have an audit. So everything about audit is centered around evidence. So it's a long topic, but then the slides have a lot of content for us to be able to understand comprehensively, with a lot of mnemonics, acronyms I've injected into it to just foster and enhance our understanding, for us to really comprehend the subject and be able to relate and practically apply to questions. Yes, please. Will you say, I can see your hand, so please go ahead.
All right, yeah. Okay, so can you hear me, sir?
Yes, please. Yes, please.
Okay, so I understand that the management has the responsibility to disclose related parties. So how about cases where you fail to disclose them fully? How can auditors identify these related parties, or are there any red flags that
I was struggling to hear you very clearly. Can you come close to the mic? Maybe I struggled to catch your question or your thoughts. Can you please come again? I struggled to really hear what you're saying. Hello, Lucia, are you there? I don't know if somebody is hearing him. I'm struggling
He
here.
can type it on the chat box. You can't hear him. He can type it on the chat box, so we can move him.
Yes, please, please, please. So usually we struggle to hear you. Please, can you type it on the chat box? So pick your question there and try to see how to answer it. Thank you very much. Maybe you have network issues or your mic is not, the volume is not increased. Okay, so please bring on the questions and we'll see how to speak to that. All right, so the next section we'll be looking at the impact on the audit of related party relationships and transactions. So having spoken to related party transactions and what they look like, there is the risk, and if it crystallizes, there is the impact on transactions that culminate in financial statements production of an entity. So the first thing is you ask why related parties increase audit risk. Definitely not all related party transactions are risky, but some can heighten risk of material misstatements. And they could be due to complex structures and relationships that are hard to trace. Like I've given some examples of some government officials that link their companies to their children, float companies in the name of their children, their spouses, their friends, just to win those contracts. So the complexity and the nature and the traceability of these transactions, it's one challenge with related party transactions. Not all come this way. Some government officials, of course, are transparent. They go through the normal bidding process. But if you look at the latest EFCC reports, one of the red flags on procurement is mostly these related party transactions where government officials hide under the guise of family members and all that in floating related party transactions. So one of it is the complex nature of these relationships with those that are providing the service in form of related parties. Then we have weak accounting systems. One of why related party transactions are risky is because of weak accounting systems, where you may not identify or summarize such transactions because of their complex nature and because internal controls are overridden by management of these companies. Also, non-market terms, talking about below cost, nil considerations, and distortions that are possible through such transactions. There are no market terms for such related party transaction, no measurement, no yardstick for this. So it's hard. It's hard and complex. That's why the audit risk for related parties is on the increase. So the auditor's objective is that with such transactions, he must understand the related party relationships and the nature of those transactions. He has to understand the entity, the nature of how those related party transactions were posted, how they came about, their amounts, their volume. So the auditor must understand that. And that's part of his objectives based on ISA 550. 2, he must obtain sufficient appropriate evidence that they are properly, number 1, identified, and number 2, they are accounted for, and number 3, they are disclosed in the financial statement. It's very important for the auditor to obtain sufficient evidence that he has identified these related party transactions, they are well accounted for by management, and they are disclosed also in the financial statement. And the purpose of understanding this is to recognize fraud risk factors linked to related parties. There are a lot of fraud risk factors. Not all related party transactions are fraudulent. You must understand that. But there is high risk of fraud perpetrated through related parties. That's what we're saying. So to assess whether financial statements present a true and fair view in relation to these related party transactions, which could be significant, the auditor must understand the nature of these transactions. And that's part of the purpose, to assess whether financial statements present a true and fair view in relation to related party dealings. And the key risk factors around this is there are higher fraud risk. Yes, there's higher fraud risk from experience, from issues that have emanated in the past. Related party transactions may enable collusion, exactly, concealment and manipulation by management. So that's the key risk factors for this. So the auditor must apply professional skepticism in dealing with related party transactions, in identifying them, evaluating them, and reporting on them. The auditor must be very skeptical in carrying out his audit work. So in short, or in summary, related party dealings may be complex, and they most of the times are complex because they are significantly and most of the times poorly recorded, or on abnormal terms. So ISA 550 requires auditors to understand and test these transactions very, very carefully and meticulously, because they pose a high risk and need fair presentation for the financial statements to be presented as true and fair. This is very important. So that's the impact on the audit of related party transactions, and they really help us to understand what it's all about. So related party transaction could be challenging and a source of excuse me, fraud risk. Okay, so I can see his question. He said, how can auditors identify related parties when management failed to disclose them fully? Good question. Excuse me. Are there red flags that could indicate the existence of undisclosed related party transactions? Good, fantastic question. So, two beautiful questions there by OO. Nice question. So let's address them one by one, because it's very important. Such questions could come under the AAAF paper, and we need to really understand. But from the lectures, we'll be able to understand what these related party transactions are all about, and it's detailed from the lectures. But then, number one, his question says, how can auditors identify related parties when management fails to disclose them? Number one is the auditor has to understand related parties first. The first thing is related parties is defined under ISA 24. Not ISA. ISA 550 deals with the auditor's perspective, but the accounting perspective is IAS 24. And it defined related party as a person or entity that has control, joint control, or significant influence over the entity, or is a member of the entity's key management personnel or close family members. So related party can also include entities under common control. So the challenge is management might fail to disclose related parties due to, number one, oversight, which is rare anyway, number two, negligence, and number three, due to fraud. And that's why it poses the risk of material misstatement in financial statements. So number one is oversight, which is rare. Number two, negligence, okay? And number three is fraud collusion, which is predominantly the reason why management may fail to disclose related parties transactions. So that's principally how auditors can, number one is understand related parties. Number two is the auditor's responsibility based on ISA 550. You should understand his responsibility is to assess the risk of material misstatement related to related party relationships and transactions. And he should be able to design and perform audit procedures. We'll be speaking to that as we go on in the class. He should be able to design and perform audit procedures to identify undisclosed related parties. So auditors cannot rely solely on management representation. He must obtain sufficient and appropriate audit evidence. It's part of his responsibility based on ISA 550 that guides related parties audit. And number three, another way is to perform procedures to identify related parties. And he could perform these procedures by reviewing legal and corporate documents, examining share registers, articles of association, minutes of board committee meetings. He could look at for also shareholding structures, the subsidiaries, joint ventures, associates. So those are the procedures he could look at. He could review contracts, loans, agreements, and other agreements for connection to related parties. Other procedures is inquiry of management and other personnel, senior key management personnel. He could ask key management personnel and those charged with governance about related party transactions, and also conduct interviews with internal staff who may have knowledge of unusual transactions. One of the fraud risk assessment I get from auditors, external auditors, is mainly on related party transactions. Are you aware of any? Do you have any documents? So I'm not a management team, I'm independent, so I could give them info, external auditors, on that. So inquiring of management and other internal stakeholders could help facilitate that. Another way is analytical procedure. The auditor could perform an analytical procedure by comparing unusual or significant transactions with prior trends or periods or industry norms. He could also investigate large or non-routine transactions, speaking to near period end that may indicate related party involvement. He could also inspect bank statements and accounting records. He could review bank transfers, journal entries, unusual payments to trace patterns that suggest related party transactions. Excuse me. He could also look for rounding amounts, figures, similar names, or transfers to unfamiliar entities that could validate his claims. He could also use technology and data analytics to detect patterns of transactions between entities with directors, addresses, ownerships. Excuse me. Mind me, I'm a bit under the weather. So, also, he could look out for red flags suggesting undisclosed related parties, like transactions at non-market terms. They could be too high or too low, like that. So he must be professionally skeptical and look out through documentation and reports to validate some of his concerns. So professional skepticism is very important in his quest to unravel hidden related party transactions by management. Yes, please. I can see Hassan's hand up. Please, Hassan, go ahead. You're trying to interject. Please go ahead.
Yes, good evening, everybody. I think it's a very good question you asked. I believe you have already highlighted most of the issues there. But what I want to add is to begin with, I think for related parties, I think you can start with the nature of the company. What's the nature of the company? Is it a limited liability company? Is it a public liability company? Is it group or conglomerate? That's also very important because in most cases, if it is a group, definitely there is a related party transaction in most cases. Or conglomerate company can have related party transactions. They're very, 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 very relevant there. Then the other issue I want to add is that you have spoken about the bank statement as well. That one is also another source where you can able to trace whether they are a related party transaction. Because if you do substantive testing or substantive procedure on the bank statement, for you to go into detail to see the transactions, like you said, the transaction that has a huge amount of money exchanging from one company to another, you need to also you can check the other company which the other company to see who are the directors. You can inquire to get the information from the company so that you know who are the owners of those companies, whether they are related or not. You can able to find out there, and as well sometimes even suppliers. You need to find out the supplier. Sometimes there are related party transactions. It's almost happening now in the world. It's what is currently going on in the world. You see a lot of companies are transacting within themselves, between themselves. You understand? Sometimes that's why we mostly have fault of, in most cases, when they are writing, what do you call it? Is it purchase order or what do you call it? You see they overestimate it or overcharge. You see companies overcharging each other. And in most cases, if you go through it very well, you see that they are related party. They are related party transaction in most cases. So these are some of the ways you can be able to, the auditor can be able to trace, to identify whether these companies are related or not. So that's what I just want to add to what you have said, sir.
Thank you so much for that. Absolutely. I agree 100%. You are right. So that's the way. And like you said, it's prevalent now in the world, especially in our, thank you, namesake, I saw your emoji. It's prevalent, especially in our country. Look at the way our government officials award contracts. They are mostly related party. Most of them hardly do all these biddings, except maybe EFCC comes after them or all that. Not just Africa, in the world also, even in the West. Most of these what crashed Enron was majorly related parties aside other issues. So from these procedures we've spoken to, those are the ways auditors could be able to identify and fish out related parties. They are not far-fetched, except if the auditor doesn't want to do his job well. If you look very significantly, you will see them. And by the time you probe further. You begin to fish them out. And by the time you start questioning directors, management, those with covenants, they just know this guy is good. He knows his job. It's very important. So thank you for that fantastic contribution, and it resonates well with us. So he asked the second question. I don't know. Are you okay with our answers or our contributions based on that? Oluseyi, are you okay with that? Before we move to the second question.
Thank you very much.
All right, you're welcome. Okay, I think we could hear you now. So let's go to his second question. He asked and said, how come there's the chat box again? He asked the vital second question. Okay, he said, are there red flags that could indicate the existence of undisclosed related parties? Sure, there are red flags. So, I think the first red flag could be unusual or non-standard transactions. Unusual or non-standard transactions. How do I mean? Transactions at terms significantly different from market conditions. So, for example, unusually high or low prices with some very unusual interest rates or fees are red flag transactions. Also, large or frequent non-routine transactions, especially close to period end, maybe around December. Large amounts are red flags. Also, round number transactions that appear artificial or manipulated. The auditor could be skeptical about that. So aside unusual or non-standard transaction, another red flag is transactions with unknown or suspicious entities, companies. You could see payments, receipts, or contracts with entities not known to management or unrelated to the normal business operations. Those are red flags. You could see new vendors onboarded, customers or service providers appear suddenly with significant amounts transactions. Those are red flags. You could see entities with similar names to employees or management or linked via family or common addresses. Those are transactions with unknown or suspicious entities. Take note of those ones. So those are red flags. Also, you could see complex or opaque structures. They could use the use of offshore companies, trusts, or trustees, or shell entities. So these are complex transactions that should raise the auditor's curiosity. Transaction routed through multiple entities or jurisdictions with lack of transparency. You can also see structures designed to conceal ownership or control. These are complex structures that the auditor needs to unravel. Also, you have another red flag, internal control and management behavior, where you see weak or ineffective internal controls over related party identification and approvals. Those are red flags. Where management is reluctant to provide information, incomplete responses, or they are avoiding these inquiries of editors. Those are red flags. Then maybe late disclosures or corrections of previous unreported transactions on the financial statements. Those are red flags. Then financial statement indicators like unexplained balances or unusual account activity in receivables, payables, loans. Those are red flags. So there are many who speak to them. It's just the auditor's skepticism and his judgment that will fish out some of. Maybe there are no hard and fast rules. There are no documented checklists. It's the auditor's skepticism and how he reviews the financial statements and fishing out some of these items that are suspicious could help bring out those red flags and help to resolve some of these issues. So I think those are my thoughts on that. Please, if you have some extra thoughts on his second question, please go ahead and speak to them very freely. And I hope it resonates with Oluseyi very much on these answers. As we go ahead, you even see some of this as we go ahead with classes or the lectures on this particular significant area. Okay, so we've spoken to the impact of the audit of related party relationship and transactions. Let's look at the requirements of ISA 550, this guide or this standard on related parties. The requirement is, you could ask why, is Why this requirement is that most misstatement comes from failure of management to disclose related parties. Of course, from these questions, sorry, somebody is not muted. There's this noise that is distracting. Please, if you're not muted, can you unmute so we don't get distracted? Okay, I tend to lose my thoughts if there are distractions. And if you want to speak, please let me know and I'll halt. Okay, so why the disclosures is that most misstatements come from failure of management to disclose these related parties, and most of the time is intentional. So ISA 550 sets minimum risk assessment procedures to detect undisclosed related party transaction, and that is why this standard came to the fore. It's very important because risk assessment is good because the auditor must consider risk of misstatement due to fraud or error. Fraud is intentional, error is unintentional from related party dealings. So he needs to inquire of management about the identities of related parties after he has done his assessment, the nature of the relationships of these transactions, the nature of transactions during the year. So he needs to inquire during his risk assessment procedure. Also, he needs to understand the internal controls. That's what the ISA 550 provides. He needs to understand the internal controls over identification of related party transaction, accounting for it, and disclosure of the same. He also needs to understand the authorization of significant related party transaction in terms of amount and size. He also needs to understand approval of unusual and significant transaction outside normal business. We call them extraordinary activities. So he needs to know the approval from there. Is it coming from management? Is it coming from the board? Is it coming from senior management or departments? So he needs to understand the hierarchy of those approvals. Then in identifying related parties, he needs to test for completeness, which includes reviewing prior year working papers, the previous audit that was done. He needs to review the company's procedures for identifying related parties. Then he needs to inquire from management about other entities, joint ventures, and companies that provide goods or services to this company he's auditing. He also needs to check the shareholders' records for major shareholders of the company to see and link names to most of these transactions. Then he needs to review minutes of meetings for board and for committees. He also needs to ask the group, if it's a group or a holding company, and other auditors, the group auditor, the component auditors, or the former auditors on issues of related parties. Because you see that there are difficulties in related parties. It's a complex area of audits, and management may conceal relationships, yes. You see that close family connections often are hidden. And it's a collusion. Collusion is a very serious risk because if the whole board members they've come together to defraud or have some benefits from this related party, it's hard to conceal by just one auditor coming that is not even involved in their day-to-day transaction. So close family connections, collusions is hard to unravel. Then transactions may be buried in normal accounting records, just hidden somewhere. So these are the difficulties auditors face. So the audit work required to unravel this is the auditor must remain very alert when inspecting bank and legal confirmations. You see that bank statement, independent and legal confirmations from lawyers of the company or the solicitors and barristers is very important. So you must remain alert when inspecting these documents, when getting response from these external confirmations. You must also be alert to board and shareholding minutes where they have these conversations, because most of these transactions are approved and deliberated on during board committee minutes or meetings. And he must be very alert to other relevant documents, contracts, and other correspondence that point to related party transactions. So in summary, significant or unusual transaction outside normal business must always be treated as significant risk during risk assessment procedures for the auditor, because they point to risk of material misstatements. And the fraud risk factors based on ISA 550 and ISA 240 speak to dominant party influence, which is a red flag. So any dominant party in a company, not just significant influence or undue influence, poses a red flag. And some indicators of dominance speaks to vetoing power, where maybe the chairman decides on who to buy or transact with. Those are vetoing decisions and indications of dominance. And you could find out in minutes of meetings. Most virtual meetings these days from boards and committees are recorded. So aside going through the minutes, he could request for recorded minutes to listen and understand the tone at the top. That's what we call tone at the top. Excuse me. Excuse me. The tone at the top, the way the meetings were, who were those making the dominant decisions, overriding decisions. He could point out to related parties there. And also from those minutes, he could also pinpoint major deals that were approved by top management. And also where there are no debates or consensus of management, those are indications of override by some maybe powers that be in the company. And they point to related party transactions. Also, transactions that are not independently reviewed before approval would be pointers, red flags. So responses to identified risk based on ISA 330 and the guide would help the auditor to be able to navigate these issues. So also, if previously disclosed related party transactions are found, you should be able to confirm the circumstances around these transactions. The auditor should inform the audit team and ask management to list all transactions with new related parties, and also inquire why the system failed in following due process of identifying these related party transactions. And where internal controls have failed, auditors have to perform substantive testing to fish out others. Then he needs to reassess risks and expand also his test and audit procedures or test of details. And if non-disclosure appears like a collusion or intentional, then he needs to evaluate the audit implication, which is the case or the norm. And also, if significant unusual transactions are found, he should inspect contracts, if there are for those transactions, inspect agreements for business rationale around the approvals and the circumstances on those transactions. You should also check if terms match management explanations, and also ensure accounting disclosure on the financial statement is proper, and also verify transactions were authorized and approved. And if stated to be an arm's length, you should obtain sufficient appropriate evidence on these assertions. So based on material considerations, the auditor needs to be guided by ISA 450. So small amounts may be material due to the nature of the related party relationship. So small amount talking about the son of the MD or the son of the chairman providing service. It could be a small amount, but then it could be material because it's the son that is providing that service. For example, assets sold to related party at below market or even zero can be material. How can you sell an asset of the company to your son or to your son's company or to your wife's company? It's not in the amount, it's in the transaction itself. The company policy may be clear that you cannot provide or sell an asset free of charge, even after its useful life. But then when that is done, it's a material issue, irrespective of the amount. So such related party transactions should be flagged by the auditor. And other requirements around this speaks to written representation from directors. They must confirm that there are completeness in the area of related party transaction information and disclosure, and the adequacy of the accounting and postings, the disclosure on the financial statements, and also communication to those charged with governance. If not all are involved in this significant issue, it must be communicated in writing that directors are not involved. Then documentation is very important because names of all related parties and the nature of the relationship must be recorded and documented. So for your exam, ISA 550 or related parties needs to be understood. So look at the area of identifying related party transactions, understanding the nature of those transactions, testing them, and disclosing this related party transaction. And it should always be treated as unusual or significant related party as a high risk. So the assessment, the risk assessment area must treat this related party transaction as high risk areas, and the auditor must document everything done in these regards. So those are the requirements of ISA 550 on related party transaction. All right, any questions on that? Any questions? Okay, I believe it's clear enough. Let's roll. So let's look at unit unit 4. Okay, so we just finished unit 4, I beg your pardon. We finished 3 sections on related party, which is ISA 550. So we'll move to unit 5, speaking to written representations. Written representation is guided by ISA 580. So ISA 550 is a related party transaction, and written representation is 580. So let's define the objectives of written representation in the first session. What is written representation? What is it all about? So written representation is a formal statement by management confirming specific matters or supporting other audit evidence. So written representation, it's a correspondence or an exchange between management and the auditor, and is to confirm matters or support audit evidence for the auditor's use. And the objective of the auditor is to obtain written confirmation from management that it has fulfilled its responsibilities. It must be in writing. That's why it's called written representation. It cannot be oral, but it cannot be perceived. It must be in writing. And this writing must fulfill that the preparation of financial statements are true and fair in management's opinion, and also providing necessary information and access for the auditor to do his job must be in writing. And those are the objectives based on ISA 580. Number 2 is obtaining supported written evidence for other audit findings where oral representations are not sufficient. As a matter of fact, oral representations are discouraged. Written representations are much more tenable and substantial. It's sufficient evidence for the auditor. So there must be response appropriately around management providing unreliable representations or management refuse to give the requested representations. So the response of the auditor must be documented on this or to this respect. So management refusal to give requested representations is very critical, and it forms a basis for either disclaiming an opinion or even qualifying an opinion or qualifying the report to some extent. So usually a letter of representation is provided and must be addressed to the auditor by management. It must be signed by senior management or the directors and dated near the audit report. This is very important. So the purpose of written representation and the importance of it is that it serves as sufficient appropriate audit evidence, but not a substitute for other procedures the auditor is supposed to perform. So having written representation is not a substitute for carrying out your job of test of details, substantive testing, and your quest to find out, dig deep. So it's a complement, not a substitute. So confirming management's responsibility also for accounts and disclosures must be in writing. That's the purpose and importance of written representation. It also helps document management's acknowledgement of key assertions and key questions. So these are the purpose and importance of written representation. So in your exams, when presented, don't forget, always state that written representation is a complement, but do not replace other audit evidence. That is the job of the auditor. So if management refuses to provide one, and the auditor is doubtful and skeptical about the integrity of management, it may lead to a modified audit opinion or disclaimer of opinion. So it's a key exam tip, please, you should take note of. So that's it about the definition and objective of ISA 580 on written representation. Yes, please. Yes, please.
I didn't get the last point there about the exam tip you just said now.
Oh, okay. Okay. So I was saying that as an exam tip, always write that written representations are complementary. They are not a substitute for the auditor performing his procedures, his test of details, his substantive testing, and obtaining his evidence. So it's complementary in the sense that he has written representation and he has also proof, which is evidence. And where management refuses to provide this written representation, then there is a risk of integrity or ethical compliance to this standard. So he should be able to modify the audit opinion or provide a disclaimer of opinion at best, because written representation should go hand in hand with his audit evidence. So where management refuses to provide it, he should document that. Then his report or his opinion should state categorically why this is done. So that's the exam tip, and questions could come around this area. So this should be your response to that. I hope that's a bit clear.
Yes, sir. Okay, sir.
All right. Okay. So we're done with section 1. Speaking about the definition and objectives of written representation, which is ISA 580. So let's look at written representation as audit evidence. Written representation as audit evidence. Written representation, like we said, is complementary and not a substitute. They are obtained actually to support audit evidence and confirm that significant matters found by the auditor during his test of details, substantive testing, are discussed with management. So most of those findings, significant ones, material ones, should be discussed and responded to in writing by management. Like I humorously always say what my former CEO used to say: if it is not documented, it's not done. So oral representations are not sufficient. Every finding must be discussed with management and documented. This is very key for the auditor, because it strengthens the auditor's documentation of management's assertions and management's responses. But it cannot stand alone as sufficient evidence. So it must come with the auditor's findings and documented evidence from what he has found in his detailed work. So this is needed because written representations are commonly requested when the auditor needs to confirm management's intention or management's judgment. For example, future business plans. He wants to confirm their plans based on current results. He wants to confirm assumptions about going concern, which is very important. He wants to confirm some valuation estimates, for example, net realizable value of revenue. It must be in writing. And that's why it's needed. Written representations are needed. He may also need to confirm the completeness of specific items in the financial statements that were disclosed around liabilities, contingent liabilities, very importantly, related party transactions. And it's important to note that the nature of representations, of which management often provides, are verbal representations during audit. So it's important to document them. And verbal evidence is weak and is not accepted. So auditors must seek written representation, which is very important for significant matters. And these written representations help to enhance reliability and document accountability from even both the auditor and the management. So limitations around written representation is that, yes, please, is somebody trying to interject? Sorry, I'm a bit fast. I may not be able to hear you, so. Somebody trying to interject? Okay, if you're not interjecting, please mute and so I don't get distracted. Okay, so I was talking about the limitations around written representations, because if representations are not in writing, they are not sufficient in known to standards audit evidence, and they may not support the audit evidence gathered by the auditor during his work. So if written representations also conflict with other evidence, then the auditor has issues. Management said this, and his evidence is pointing to another thing. The auditor needs to reconsider the risk assessment of that area that conflicts his evidence and what management has provided as their own answer or assertion. So the auditor needs to also perform additional audit procedures to validate, because like we said, written representation needs to complement his evidence and they need to tally. So where there are dichotomies, he needs to resolve that appropriately. And he needs to also evaluate management integrity. And if he's in doubt of that, then he has to consider resigning. That's one thing, because where collusion is perceived, the integrity and the name of the audit firm or the auditor could be dragged in the mud when something goes wrong. So he could consider where management have displayed utter disregard for process, for controls, and their integrity is in question. The auditor could consider withdrawing from the engagement. So other required representation besides, or the guides, ISA guides beside ISA 550, also require specific written representation like ISA 240, the standard on fraud and management's responsibility. They all point and support ISA 580 on written representation. So ISA 240 on fraud and management's responsibility is a substitute. They are also required. ISA 250, compliance with laws and management and laws and regulation, NOCLA, also says or supports ISA 580. ISA 550 on related party disclosures also support that. ISA 550 events after reporting periods needs documented written representation. ISA 570 on going concern also speaks to that. So these are usually included in the letter of representation. That's the response from management to the auditor. So for your takeaway, you need to understand that written representation complement other evidence as extracted by the auditor during his work. And also documentation of management's accountability is the reason for written representation. But they cannot replace independent audit evidence gathered by the auditor or corroborative procedures he has gathered during the work. So that's written representation and its complementary nature with that of the work, which is the sufficient appropriate audit evidence the auditor gathers during the audit work. All right, so this is 8:59.